Hello, everyone, and a very warm welcome to today's major markets update for February the 3rd, 2024. Why do I have the slide from last Friday up? That is because we were looking for the wave 4 pullback, and that one we most likely got on Fed Day on Wednesday, and wave 5 should now be underway. Correct slide? Correct number. So this could be 5, 5, 5, 5. Okay, so it could be we're racing closer and closer to a more and more important top. Let me be honest, straight up. We could see a pullback to, let's say, about 4,500 and then still a rally to 52, 5,300 on the S&P 500. Alternatively, we're going to top out somewhere around 5,025, 5,045, and that's it. There are more under the hood developments that are not good going on, meaning divergences, but those are conditions, not triggers. Price is the final arbiter, and we haven't seen a drop below any critical level, which are the red levels, at any stage since we've been tracking this rally since the January 5th low reasonably well. So let me go to the plethora of charts I have. I have many charts with you to share because there's a lot to go over. Here is the hourly chart of the NASDAQ 100. We're going from hourly to daily to weekly to zoom out to kind of get a better idea where we are in the bigger picture. So we were looking then for this potential blue 3, blue 4, blue 5 when I presented the update pre-Federal Reserve. Looks good for that. Picture perfect 5 waves C wave. We had a leading diagonal wave A, a bounce wave B, and then this wave C. All right. On the NASDAQ of a S&P 500 counts different, but again, the end result is the same. I also want to point out the dotted arrows. This was the path we already forecasted here mid-January. Up, down, up, down, up. Okay. Of course, we cannot get all the detailed nuances, right? But we all know that fourth waves are ABCs, whatever ways, but we're not going to put that in the chart. I could have, then we had just a down, up, down. Again, none of these have been changed in their target zones whatsoever. So it has been transpiring amazingly well. And of course, when we got this bounce here, we were already tracking for the potential that this wave 4 was completed. But then we, of course, set price levels where we said below that price level, that impulse is not going to happen. We did see the impulse on the S&P 500 because the S&P 500 did go above this gray wave 3 high, just to show you that some indexes are not always exactly aligned on a smaller time frame basis. Regardless, we got 5 waves lower, and now we're back at new uptrend highs. It appears to me that the NASDAQ and NASDAQ 100 are not yet entirely complete based on their bigger picture gray Fibonacci extensions. The 176.4 to 200% is typical 5-wave target. We haven't reached it just yet. Now, a 5 is one relationship, as you can see, also targets right around there. Okay. However, we can count 5 waves up based on this method of closing prices on the hourly or the 65-minute candlestick basis. It's not always correct. So I would like to see another push higher into this 70,740, 70,890. It's not necessary. Okay, it's not necessary. There are technically enough waves in place. First warning is then below this potential orange wave 4. Second warning is below Friday's low. Third warning is below about 70,275. Final warning, and we open Pandora's box below the gray wave 4 low. Okay, the Fed low. If we go below that one, it will open Pandora's box, and we will see at least a 20% correction, in my humble opinion. Now let's make it 15 plus minus 5. At the minimum, potentially, bear market has started. Okay, that's the only 2 options I have, and I'll show you that in a moment with using the daily chart. So the daily chart, as you can see here, we're a little bit shy here of this ideal wave 5 of 5 target zone, right? The gray one. Wave 3 topped exactly where it had to. We had a picture perfect wave 2, by the way, which was 61.8%. Wave 3, wave 4 bottomed exactly where it had to. So we allow for this wave 5 of 5 of 5 of B/3 to also top where it should. I have no indication whatsoever that the top is in place. However, I can now raise on a daily time frame the warning levels. Okay, so the first warning level, I would say, is a break, of course, below the low here. Okay, the second warning level will be on a break below Friday's low. The third warning level will pretty much go here, and then of course our final warning level is, I would say, there. Then the impulse is complete. Okay. But I have no signs that the top is in place yet. No signs whatsoever. We continue to make higher highs, higher lows. But this looks like a picture perfect, beautiful Elliott wave Fibonacci-based impulse pattern. So far, so good. Negative divergences are starting to develop, as you can see on many indicators. The RSI 5, on the MACD, and of course also here on the money flow. But there are still dotted, so they're tentative. Okay, but we saw it here in June, July as well, of course, happen on these indicators, right? As you can see there. We saw it here again in November, December. And I wanted then to point out that it is possible that we get a black 4 and another black 5. Okay. As you can see here, this will bring us back to about the November lows, somewhere around there, or the early December, late November lows, which equate to about the June, July high here. Why is that? Because of the 1, 2, okay, in black. It's not here on the chart, A, B, 1, 2. This could be an A, this could be a B, and then we have a 5-wave C wave, okay? I'll show you that also using the regular NASDAQ. So we can have still a pullback and then another rally. But again, this pullback, it's nothing to mince about, and it is possible that we will go, of course, much, much lower than that. So that would be about, a 10% pullback, somewhere around there, potentially 12, something like that. Could be even deeper, but I'm kind of going by support resistance levels at this stage, okay? We could, for example, also put in another way of looking at it is volume by price, right? We're going to check that one as well. And you can see here, volume by price has quite strong support here in this region, okay? So it's quite reasonable that we see support here. Now, let's say we're going to drop all the way to about 15,000 and then we rally. Now, if we see a drop 15,000, right, from about 18,000 to 15,000, there you go. That's your 15% correction. That's nothing to mince about. Going on to the regular NASDAQ, as you can see here, we topped in the ideal wave 3 target zone. We bottomed in the ideal wave 4 target zone at the 76.4. If we do that, it tends to go to the 176.4 for 5S1. We're not there just yet. So it looks like a couple more updates would be necessary. Okay, that would be nice to complete this picture perfect, beautiful standard Fibonacci-based impulse pattern with, again, here this ideal target at around 15,782, 15,732, somewhere around there. Okay, that would be absolute ideal. 176.4, 200% to complete this impulse all the way from the October 2023 lows. Also here, potential negative divergence developing, loud and clear. Okay, meaning we're going higher and higher with less money flowing in. Look at Friday, very little money was flowing in. It was absolutely mega cap rallying and nothing else. If we count the rally since the October low slightly different, then we have a larger 4 pullback and a larger 5 now underway. Okay, you see the slight nuance. It's a slight difference. We had green 3, green 4 here, and we're going to put green 3, green 4 here. Potato, potato. It's simply a matter of how do you interpret this whole rally. This rally is very difficult to interpret in the sense that we had, especially in the beginning, barely any pullbacks. This is a one-day pullback, a one-day pullback, one-day pullback, and then a little bit here. It's very hard to interpret from that sense. But also this one points to the same, and that is the 3/C question. Let's see if I can capture it on a 2-year time frame. Yes. So why is this potential a 3? Because of the rally from October into December. This one. Is this a 1 or a A? Is this a 2 or a B? Then the question is this a 3 or a C? If it's a C wave, then this was only a larger B wave. The October 2020 low was an A wave, and we're going to start a C wave. Okay? Very possible that it is, of course, going to be 1, 2, 3, 4, 5. That's why we have that on the chart, 3, 4, and 5, because the NASDAQ 100 counts the same, obviously. So it is always very critical to know, are you counting the initial rally correctly? If you're missing one first wave at the beginning, you'll miss out at a last fifth wave at the end, right? You misinterpreted that one, you'll miss that one at the end as well. It compounds, so to say. So we have to be very cautious. Is this a wave 1, a wave 2, or is this an A and a B? And this was all of C. We have definitely 5 waves up since the December low. 1, 2, 3, 4, 5. No question about that. Okay. Also on the S&P 500, we have 5 waves up from the October low. Not 3, but 5. Okay, that I must admit. So how are we going to resolve that for the S&P 500, bigger picture-wise, if we see a 4-5 on the NASDAQ 100? Well, we could see an A, B, C of a ending diagonal. I'll show you that for the Dow Jones as well. Okay. Wouldn't surprise me if that's the case. So that's where we're currently at. The NASDAQ suggests a little bit higher. We're currently at 15,628, 100 points, maybe 250 points higher. That's it. That would be picture perfect. Can always extend. That I don't know, right? We can always have extensions, but we go by the known unknown, okay? Or the unknown known, however you want to phrase it. Fibonacci standard impulse pattern. And then once we top, we'll see if we're going to get a pullback to about even 15,000 on the NASDAQ 100, or about 15,000, 16,000, somewhere around there, right? So make it 15,000, 500 plus or minus 500. That's what we initially go by. And then see if we get another rally out of it, because of the notion that we don't know if the rally from October into December 2022 was an A wave or a first wave. Okay? Please keep that in mind. But things start to look pretty tired, that I must admit. So this is then the S&P 500 hourly time frame. We adjusted it with the 1 degree lower wave count. That the 24 high wasn't gray 3, and the 25th low wasn't gray 5, but orange 3, orange 4, etc. 3, 4, 5. 3 could also be here, and then we have an A, a B, and a C wave. A little awkward, because normally C waves are 5 waves, and currently decline on Wednesday was clearly 3 waves. 1, 2, 3, 4, 5. Also here, please note, we have reached the 223.6% extension at 49.75. We topped so far on Friday at 49.75 per 29. Okay, picture perfect. So we've technically reached the extended 5th wave target zone. Why is it extended? Because wave 3 was extended with this added wave count. We went almost to the 200%. And we stalled here even shy of the 100%. And then a 5-1 has also been extended. So we can even move higher to the 300% extension if it wants to. Why is that important? Because there's wonderful Fibonacci confluence here at 5,026 to 5,048. Okay. 5,025 is the 238.2% extension of the 1-2 setup here in green. Okay. That one. 525, 526. As you can see here, we topped in the ideal wave 3 target zone. We bottomed shy of the ideal 4 target zone. And we're now in this 5 and 5, 5. There's, for me, no other way to count this rally since the January 5th low than this. And now this could be a extended 5th wave. We've seen this in the market many times before. Again, potential negative divergences are starting to develop. This is our trusted weekly chart. I've shared this one many times with you before. 5,026 has been on the chart. This green arrow has been on the chart for many, many weeks. We haven't gone below any critical level. Also here, even on the weekly time frame, it almost looks like you can count 5 up. 1, 2, 3, 4, and now in this way 5. So we're getting awfully close. Okay. 5048 is the 200% extension of this black wave 1 here in the left-hand side of your screen, M2. And that's typical fifth wave. So 5048 and 5026 is off by 22 points, right? On 5048 is nothing. It is really nothing, is 0.4%. So that is extremely accurate if we top in that region. I do want to point out the extremely overbought money flow. This is as overbought as it's been, and pretty much since data is available. Let's go back 40 years in time. Okay, I have to go 40 years back in time. The last time it was this overbought was all the way back in 1998. 1998, we almost went to 100. It's never been as overbought since then as today. Or Friday. Friday, the weekly money flow was the second most overbought in the indicator's history. There's about 40 years of data. I can go back, I think, 45 years, and then you will see I don't have any more data. So we're going back to the 1980s. So we have a quite extensive database, right? We almost have over 40 years of data. So this is reasonably relevant. All the other ones have never been this overbought, so I can't really compare things, honestly. What we see here in 1998, that when we got this overbought, there was a little bit more of a rally and then a 20% correction. That kind of matches with what we just said for the NASDAQ 100, that we could see a 4 and then a final fifth, right? It's still possible. Now, if you want to compare apples to apples as much as possible, let's start then from the 2009 low, which was the most important low pretty much since the rally that started out of that low. Then we have some comparable setups: 2011, 12, 14, and 18. Okay. Now, as you can see, every single time the market moved a little bit higher. But again, these are lower readings. So we are kind of comparing not apples to oranges, but apples to tangerines. That's kind of, or mandarins to tangerines. They're almost the same, but mandarins are not tangerines, and tangerines are not mandarins. So what it says is most of the time you see a big correction, slightly higher, even here 2018, slightly higher, big correction. Every single time it went well below it. Okay, why? There's just so much money flowing in. The only thing it can do is money flowing out. How big a corrections did we get? Okay, let's have a look. How many big corrections did we get? From there, your risk was 20%. Okay, from there, your risk was 12%. From there, your risk was 8%. From that level, your risk was 12%. Okay, anywhere there. So every single time, we had a pretty decent correction, and then it moved higher. Okay, so that kind of matches the narrative for this potential 4-5 setup, if this is indeed a 1-2 setup. I'll show you in a minute how that can be resolved for the S&P 500. How can we resolve this if this is then indeed not all of the wave 5? Okay, if this is not wave 5 of 5, how can we resolve this? Well, we shared this chart with you before, thanks to, I must say, pretzel logic, and that is that we might have a ending diagonal. Also for the S&P 500, this is the Dow Jones. Okay, we have a ending diagonal setup, something like that. Okay, let me see. And again, it's a little bit, you know, how are we going to draw this upper line? I don't know. That's a little hard to know, right? So how are we going to draw that one? What are the targets for that, right? What that's always a little hard to know for the ending diagonal. So maybe we're going to go a little bit higher, right? 4 or 5. It is very possible. Ending diagonals are very tricky. So then this C wave might subdivide also. So we're going to go for C, something like that, right? We don't know. We don't know really how exactly this ending diagonal is going to fit in, as long as the third wave is not the shortest wave. That's all we need. Okay, that's all fine, as long as the third wave is not the shortest wave. So we could be very close to this one. We get a 4 and a 5, and the 5 will go marginally higher. Note this very nasty negative divergence developing on all the technical indicators for the Dow Jones as well on a monthly basis, right? So that's not looking too good. That's a way to resolve the S&P 500 from a potential large 5 or 5 or 5 top, aligning it with the NASDAQ for a 4-5 setup, okay? I don't know yet, I can't tell you. Now, as you can see here, the Dow Jones is getting also close to its ideal 1.236 times A extension. That is a classic third wave target zone within a diagonal, okay? That is very classic. So we have then a very nice ABC setup there. Okay, I like it. So ABC. And again, this rally also is not really ideal, but I must say we haven't broken below any critical levels other than last week, the blue level. So we can change things a little bit. All right, so Friday's low is now our blue level. Thursday's low is, of course, our gray level. We can keep the orange level here at the wave 2 and the red level here at the wave 4. Okay, so far so good. I like it. 1, 2, 3, 4. Very complex wave 4. And now also in a potential, of course, ending diagonal. Okay, we could also be here in a ending diagonal. But somewhere around 39,000 would be a picture perfect ideal setup. Again, we can resolve the Dow Jones as a ending diagonal, which would allow also for the S&P 500 to turn this whole rally into a ending diagonal. 1, 2, 3, 4, 5. All right. So we'll put a new chart out for the S&P 500 as well using this ending diagonal potential. Semiconductors, yeah, they're definitely lagging. They used to be the winners and now they are the losers. I still expect a final wave 5, but I'm not holding my breath. Okay, a final wave 5, but I'm not holding my breath. So now we're going to look at, are indeed a handful of stocks pushing the market higher, yes or no? There's a lot of arguments for and against it. The Magnificent Seven, as you know, doesn't include Tesla anymore because Tesla is, of course, down and everything else is up. Well, this is the value line geometric index, which kind of treats everything equal. And as you can see, we're still miles away from the all-time high in 2021. Okay, so this one tells us that based on everything equal, we're not looking too good. Well, that is, of course, small and mid caps, which are really not doing well. If we then look at the equal weighted index as well, as you know, the regular S&P 500 is based on the unequal weighting, right? It's just market cap based. We're still not above the 2021 high. Okay, still not. So this does suggest indeed that we are being pushed higher by a handful of mega cap stocks. Do want to point out the EMA 5 of the slow stochastic is starting to turn over on this one as well. We're not yet on a sell signal, but it doesn't look too happy either. So yes, these indexes do tell us that it's not a handful of stocks pushing the stock market higher, but they have an outsized impact currently on the stock market. So it's kind of lopsided. It really is. And we have other indicators for that as well. Before we go to the other indicators, let's look at the timing. All right. This is the Armstrong pi cycle. You can look it up as well. You just apply it, what he posts on the web. So we have our large cycle in black. We have our second large cycle here in red, which is 3/4 of the black. 3/4 is from the 2002 low to the 2009 low, okay? And then green is half of black, orange is half of red, and blue is half of gray. So we have a nice fractal time frame of this pi cycle. And as you can see, we can identify some very important tops, okay? Here in 2011, here in 2015, very close to 2020. I think we missed it here due to the Federal Reserve's quantitative easing, but still pretty close. Also here, really close. Okay, here, pretty close. Of course, the low here. And the other ones are not necessarily always nailing it, but I want to see overlap, right? So here we have black with, of course, green and blue, but those are, of course, the stronger ones. Those are smaller cycles within larger cycles. We have, of course, here the 2021-22 high, okay? That is 3 red cycles, right? Picture perfect. That align, of course, with the smaller cycles and the blue cycles. So this was pretty strong confluence. And now again, we're at the green and the blue one. Okay, so also here, reasonably strong confluence. It's a condition, it's not a trigger, but we have reasonable data to suggest that, okay, we're getting closer to a turn, which aligns, of course, with the Elliott wave count. This is our about 60-day cycle. I have dumped it down here from the July high into the October low. And again, that suggests we should see a top pretty soon, either here in February or in March. It's a little bit, of course, potato, potato. And how many days are you actually counting, right? It's always plus or minus, I would say at least 3, something like that, sometimes even more. But if we go here, of course, to 3 days shorter, that gets us, of course, already much closer, right? So you get the idea. What I do want to point out here as well is the analogy between the June into July top from last year versus now. Because of Elliott wave, we had our wave 3 top here, then we had wave 4 here, 1, 2, 3, 4, 5. Okay, wave 3 top here, wave 4, 1, 2, 3, 4, 5. Okay, that is very similar setup. This is the repeated fractal nature of the market. I mean, it is very obvious. Okay, please keep it in mind. And how close we are to very important Fibonacci levels. All right, let's go to market breadth. This is the warnings I'm seeing. It's a condition, it's not a trigger. We're moving higher with less and less bullish charts. Only 54% of the charts in the NASDAQ are on a buy signal. Compare that, for example, where we were here, late 2020, 21. Okay, look at that. So late 2020, early 2021. Almost all charts on the NASDAQ were on a buy. 50%. It's pathetic. It's really pathetic. Once again, shows which stocks are driving the market. Indeed, the mega cap, the Metas, the Microsofts, the Googles. Look also at Apple, by the way. Where's Apple? Apple is already started to crumble too. The Nvidia might be added to the list. Definitely not Tesla, but it's the mega cap stocks that are really pushing this market. Otherwise, we would be in the 8. That's healthy. This is healthy. This is what you want to see, a push above 70. We've not seen a push above 70, which indeed tells me this is a last gasp higher. Now you can see that we can take about a year for this negative divergence to develop. But once it kicks in, you have a 57% correction. Okay, still first a 23% rally. Same here in January of 2023 into the summer of 2023. We first had a 34% rally and then a 20% drop because there was negative divergence. Can last a while, right? But that's what we're seeing as well. So always consider the risk versus reward. Similar for the S&P 500. The bullish percent index dropped below 70. Normally, that is a sell signal. Okay, it's a sell signal was here. Okay, every single time, a sell signal here, loud and clear, sell signal. Every single time it drops below 70, it is a sell signal. Doesn't mean it's guaranteed to be profitable, but it means that if you top at these high levels and then drop below 70, that the internals of the market are weakening. Now you can see here the red arrows show how long this negative divergence can last before you see a meaningful correction. Okay, and some corrections are much deeper than others. Look at how tiny the negative divergence was here in early 2020, and we got this massive COVID crash. Now see how big the negative divergence is here in the summer of 2020, and all we got here was a marginal pullback. Same here. This was 6 months of negative divergence, and all we got was this pullback, and then another rally. Sometimes we have negative divergence, and it doesn't even matter. Okay, so this is again a condition. It can always be rehabilitated, right? It can always be restated. Negative divergence can be erased. Divergence is only divergence till it's not, but it must be noted because history is full with examples where it matters. Yeah, how am I going to use this in my trading? Right, raise your stops, start to sell into strength. Maybe throw in a couple of hedges, that type of stuff. There are two types of traders, old traders and bold traders, but there are no old bold traders. So if you completely ignore all these signals, then it's on to you if you do not take any appropriate measures. I can't tell you what to do. I can tell you which price levels to set your stops at. It all depends on your own personal risk level. Some people want to only use the hourly charts. Some even go to minute charts. Others only look at monthly charts. It all depends, and it's all good. That's what makes the market. But I cannot tell you which to use. So this is an example of where potential negative divergence we were looking for got rehabilitated. So we have a higher high here in January, and that move higher caused now the rally we're seeing here, okay? But now we have negative divergence. Yesterday was a rally on a decreasing AT line. I saw a tweet, I couldn't find it anymore. This has only happened, I believe, 3 times or something since the last 25, 30 years. Interesting, doesn't tell us too much. I think twice ended badly and once ended good. So that's pretty much the gist of it. If we look at new 52-week lows, it's also interesting. It's incredibly high, triple digits for the NASDAQ and double digits almost above 50 for the NYSE. So we're moving higher, but new 52-week lows are increasing. This is also a warning sign. Again, it's a condition, not a trigger, but it is a warning sign. As you can see here, the new 52-week lows have been pointing consistently higher since January. So something is not right in the market. It can always be completely erased. Throw a couple of trillion at it and you're good. But must be noted, once we go over 50, and remember the NASDAQ has remained steadily too high, but ignored it. But it's not what we'd like to see. Normally you want to see this. Okay, this is what you want to see. The NASDAQ has not seen it. New lows are increasing while price is increasing. Not good. Another example here is the NEMO or the NIMO, whatever you want to call it. So we had a field buy signal and another field buy signal. As you can see here, the NYSE moved higher on a negative McClellan oscillator. So more stocks were declining than advancing on the NYSE. That's not good. That also suggests it was primarily Meta and Google that were pushing the markets higher. Can it be rehabilitated? Absolutely. Can it be erased? Absolutely, right? That's the thing. But for now, not good. Okay, that then means the summation index remains on a sell. It's been on a sell ever since early January. So if you use this for your buying and selling, you have not been in the market. You've completely been out the market using this one. You've been in it since November. You're out of it since January. Massive run. Great. Same here. You wanted to short the market. Then you started to short the market here in July, all the way here till November. Great trade, great trade. Okay. You would do same here, but then you will see it's not a good trade because here you would short it when price was here and you would get out when price was here. Then you went long and did it again. Okay, long here, out. Okay, so again, this indicator is not always perfect, but it remains on a sell and waits to the evidence of the other indicators. How are we doing on the PMO? The PMO gave a sell signal and it's back to a buy signal. That's interesting. So this one is whipsawing as well. It's not very high confidence, right? This is not the same as we saw here in November. This is kind of a weak signal, but it's a buy signal. So we're back to buy. It went from sell and it's back to buy. The sell signal was never confirmed, by the way, by the known sure thing indicator. So we're back to a buy and buy it is. So this one is also a little bit weirdly hesitant, I would say. It's not an ideal buy signal, right? It's a little awkward, but buy is buy. So this one is on a buy. That's okay. Good. How are we doing on sentiment? Well, money managers are overexposed. The market 87%. Okay, their average long-term is about 70%. We're at 87%. No real alarm yet. That is when we get above 100, 105. meaning then we're leveraging. The active money managers, which are supposedly the big boys, are leveraging. So far, it's definitely moving intact with the market. So not much to learn from this one. Mom and pops are extremely bullish on the market, 49%. It's not as high as it was late December. Okay, and what happened late December? Let's have a look here. Which one would be the best? Somewhere late December. Well, we still saw a slight correction, of course, into early January and then higher again. But it is pretty bullish from a contrarian point of view. Let's see if the market responds. How are other people viewing the market? This is a post from Xenia. She posted January 22nd for the NASDAQ 100 that she was looking for this 345 setup into the high 17,000s. Okay, that's what her post, and it really matches well with what we were seeing. I congratulate on her, and I must say, very few of the other waves I follow actually saw this. And yes, we have the same wave count, and we're now in the stopping zone. Also here, it looks like at least we've reached the minimum. Okay, potentially up to 70,915. Okay, that's kind of what we're seeing. After 70,890 is the 200%. So I still think we should see a little bit higher, but it's not necessary anymore. Okay, we're there. And she says as well, a break below this week's low will open up Pandora's box. Indeed, if that's the case, then expect at the minimum this wave 4. That is my expectation. I've set it here at about 15,800, but let's use the price volume shelf and say we're going to probably bottom somewhere there. Okay, this would be our wave 4 and then a wave 5. Okay, and if we go below this one, especially the October low, all bets are off. And if this is a black wave 4, it's going to be bigger and nastier than this red wave 4. Okay, that's for sure, because this was the red wave 4. See that? Which is going to be barely half, I would say. Well, by 3/4. Okay, let's give credit where credit is deserved. But this is probably wave 4. Okay, and that would again resolve probably for the S&P 500, as we saw for the Dow Jones, as most likely an ending diagonal. Wouldn't be surprised. It's all ABCs, ABC, ABC, ABC. We could wrap this up real quick. Potentially already wrapped it up, by the way. So that's where we are. And what else are we seeing? So that was Xena. Kudos. Absolutely great call. Absolutely. Other alert waves I track on Twitter/X. Were only patting themselves on the back for other trades, but not necessarily on their faulty alert wave counts. But it also shows you can still trade well, even if your alert wave counts is not really 100%. And it's not 100% for everybody all the time. It's definitely not for me. How are we looking for updates by Avi Gilbert's group? Well, they have this nice potential 3-4 setup as well. And they had a little bit lower prices, about 4,800. Well, I think we got 48.45 and off to the races. Fine. I think that looks good. So that's the 4 and that's the 5. And they are looking here for a high anywhere between 5,000, 4,997, and 5,057. Okay. So if we see a bigger pullback, as I mentioned, for the A, the B, and the C wave, like that, you can see how we can target 52 to 5,300. Okay, this is still very possible to be reached, this upper end. That's why I mentioned if we see only this black wave 4, as I shared with you for the NASDAQ 100, which will be then a black wave 4 from a ending diagonal on the Dow Jones and S&P 500, we can still target 52 to 5,300. Okay, so this ABC is still very possible. Then this whole rally since the 2020 low has morphed for the S&P 500 into an ending diagonal and a reasonably clean, clear impulse for the NASDAQ 100. So I think we have most things aligned. We have it aligned with the alert wave count with the technical analysis. I think we have it nicely aligned with market breadth, which is again, screaming warning signs, but they can last a while, as you've seen from historical analysis. Extremely overbought on several time frames. The second highest overbought money flow level in 40 years of data, only surpassed by one data point, 1998, which was then followed by 20% correction and another rally before the market went into its 2001 and 2 bear market. So that could still be the case as well. Okay. Sentiment extremely bullish. From a contrarian perspective, that is not good. And market breadth is diverging. It's a condition, but not a trigger. Okay. It's a definitely increasing new lows, all those things. So you get the idea. I still think we can go a little bit higher. 5,026, 5,046 would be ideal. Okay, that would match with a lot of these larger Fibonacci-based patterns. It would match also with the NASDAQ 100, not yet having reached their ideal wave 5 of 5 of 5 target zone. Okay, the Dow Jones should also be able to move a little bit higher to get to the 123.6% extension. That'd be great. That would be looking really nice. Okay, and from there, we'll see again. We could get about 15% pullback and then new all-time highs, or the top is in. Take care, trade safe, and I'll catch you all next week.